All right, so let's dive into a question we get all the time. Should you pay off your mortgage as fast as possible or use that money to invest?
Yeah, this is like the classic financial dilemma, right?
Exactly. And today we're looking at two totally different takes from YouTubers James Johnson and Chris Cho.
One says paying off your house early could actually be a huge mistake, and the other one, like, really gets into the nuts and bolts of mortgage math, so.
Get ready for some serious aha
Yeah,
moments.
this is gonna be good.
Okay, so first up, James Johnson, he's like our resident expert on retirement and estate planning, and he comes out strong saying, paying off your house could be a $2 million mistake.
Whoa.
Yeah, right. $2 million. Like, that's a bold statement.
It is, and his argument is that the money you have tied up in your house, it's not really doing anything for you.
It's just sitting there.
Yeah, he calls it dead money. It's not earning you any return,
Uh-huh.
and it's not super easy to access if you need it quickly.
He uses this analogy of a house as a cup.
Oh, I like that.
Right. You pour all your cash into this cup, but it's not going to magically multiply just because it's sitting in there.
It's about opportunity cost, right?
And-
Like, what could you be doing with that money if it wasn't just stuck in your house?
Exactly. Could you be investing it and potentially earning way more?
Potentially a lot more.
Okay, but $2 million, that just seems like such a huge number.
It does. But he actually breaks down the math to show how he gets there.
Oh, really?
Yeah. So let's say you have a $500,000 house. If you paid cash for it, boom, you own it outright. No mortgage payments.
That's pretty good.
But what if instead you got a mortgage and invested that $500,000 at a 6% return for 30 years?
I'm intrigued. Let's hear it.
That invested money, even with a pretty conservative 6% return, would grow to over $3 million.
Whoa, that's a massive difference.
Right. It makes you rethink this whole rushing to pay off the mortgage thing.
Totally. And, I always thought paying off your mortgage early was the smart move, but Johnson really debunks a lot of those, common mortgage myths.
Like what kind of myths?
Well, those things we've always heard about large down payments, 15-year mortgages, and making extra principal payments.
Oh, yeah, those.
He basically flips those ideas on their head.
He even has this true or false quiz about them, and honestly, I got some of them wrong.
Me too. So what did he say about the 15-year mortgage?
I always thought shorter loan terms were better.
Well, he actually says that banks make more money on the shorter loans.
Wait, really? I thought they'd make less overall because they're collecting interest for a shorter period.
That's what I thought too. But it's all about faster returns and re-lending that money.
So they get their principal back quicker and can lend it out again, making even more interest.
Yeah, that's the gist of it.
It's like they're playing the long game.
Exactly. And it highlights this important point that not everyone giving you financial advice has your best interests at heart.
Oh, for sure. We need to think critically and not just blindly follow what we're told.
Absolutely. Now, one of the things that really hit home for me was his earthquake scenario. It's kind of dark, but it makes you think about security in a different way. Okay. All ears.
So picture this: two neighbors, one with a nearly paid-off house and the other with a bigger mortgage. Then, bam, a huge earthquake hits, and both their homes are completely destroyed.
Oh, wow. That's awful.
Yeah, it's a horrible situation. But think about it. The neighbor with the almost paid-off house might have felt secure knowing they own their home, but now it's gone. Their whole investment is gone.
Right.
But the neighbor with the larger mortgage, they still have that cash that wasn't tied up in their house, which is now rubble.
It's a powerful way to illustrate liquidity.
Exactly. And it brings us back to Johnson's mantra of safe, liquid, and earning a return.
A paid-off house might seem secure, but is it really the best way to manage your money?
Yeah, that's the question he's posing. He's really pushing us to rethink this idea that owning your home outright is like the ultimate financial goal.
So Johnson definitely gave us a lot to chew on when it comes to paying down the mortgage versus investing. But what about the actual, mechanics of mortgages?
Well, that's where Chris Cho comes in. He's our mortgage guru, and he really dives deep into the numbers and formulas that lenders use.
Perfect, because I've always felt a little intimidated by that side of things.
I think a lot of people do, but Cho breaks it down into 3 key formulas that are super important for understanding how lenders evaluate you.
Okay, lay it on me.
We've got loan-to-value ratio, or LTV, gross monthly income, and debt-to-income ratio, or DTI.
Got it. LTV, GMI, and DTI.
Yeah, basically your financial report card.
Okay, so first up, LTV, loan-to-value ratio. What does that even mean?
It basically measures how much of your mortgage you're borrowing compared to the value of your home.
So, a higher LTV means you're borrowing a larger chunk of the home's value, which is riskier for the lender, right?
Exactly. They want to make sure that if you default on the loan, they can at least get their money back by selling the house.
Makes sense.
So a lower LTV means they're less likely to lose money if things go south.
So how do you actually calculate LTV?
It's pretty simple. You just divide the loan amount by the appraised value of the home. Cho uses the example of Lewis and Clark. They're buying a house for $350,000 and they're putting down a $70,000 down payment.
Okay, so their loan amount would be $280,000.
Right, so their LTV would be $280,000 divided by $350,000, which is 80%.
And that's pretty standard, right?
Yeah, 80% is a fairly typical LTV for a conventional loan.
Okay, cool. So why is this LTV so important for us regular folks?
Well, a lower LTV usually gets you a lower interest rate.
Because you're seen as less risky to the lender?
Exactly. You've got more skin in the game, so if you can swing a larger down payment, it could save you a lot of money over the life of the loan.
Interesting. All right, next up, gross monthly income. That seems pretty straightforward, but I bet there's more to it.
You're right. Lenders are really looking for that stable and consistent income, not just how much you make each month.
So they're digging into your pay stubs, tax returns, employment history to see that steady income.
Yep. And they calculate your gross monthly income differently depending on if you get paid weekly, biweekly, or semi-monthly.
Oh, yeah. I always get those calculations mixed up. Can we break those down real quick?
Absolutely. So for weekly pay, you multiply your weekly gross pay by 52 and then divide by 12. If it's every other week, you multiply your biweekly pay by 26 and then divide by 12. And for semi-monthly, you just multiply your semi-monthly pay by 2.
Okay, that's actually super helpful. I'm going to write that down. All right, let's move on to the big one, debt to income ratio, or DTI.
This is where things can get a little more complex.
I was just thinking that, but hopefully Cho can make it make sense.
He does a great job. So DTI is really important because it shows lenders how much of your income is already going toward debt payments.
So they can see if you can actually handle another monthly payment, like a mortgage.
Exactly. The lower your DTI, the better your chances of getting approved and getting a good interest rate.
Makes sense. A lower DTI means you have more wiggle room in your budget to manage all those debt payments.
Right. And Cho mentions there are actually 2 types of DTI, front end and back end.
Ooh, okay, what's the difference?
So the front end DTI, also called the housing ratio, focuses specifically on your potential housing expenses.
Like your mortgage payment, property taxes, homeowners insurance, HOA fees, all that.
Exactly. It's a laser focus on those housing costs. Now, the back-end DTI is the more comprehensive one. It looks at all your monthly debt payments.
So that includes the potential mortgage payment plus any other recurring debt you've got going on?
Like car loans, student loans, credit card payments, personal loans, the whole shebang.
Okay, so lenders are more interested in the back-end DTI because it shows the bigger picture of your debt.
Exactly. It tells them if you're already stretched thin or if you have room to take on a new loan.
So let's walk through an actual DTI calculation using Cho's example with Lewis and Clark.
Okay, so they have a combined gross monthly income of $6,000, and their estimated mortgage payment, including principal, interest, taxes, and insurance, will be $2,100. To calculate their front-end DTI, we divide the mortgage payment by their gross income.
$2,100 divided by $6,000, that gives us 35%.
Right, so 35% of their income would be going toward housing costs. Now, for the back-end DTI, we need to add their other monthly debt payments. Let's say they have another $700 in student loans and car payments.
So $2,100 for the mortgage, plus $700 in other debt. That's a total of $2,800 in monthly debt obligations.
And then we divide that by their $6,000 gross income to get their back-end DTI.
Which comes out to 46.67%.
Yep.
That's getting pretty close to that 50% mark that lenders usually look for.
It is. For conventional loans, they usually want to see a back-end DTI below 50%, but it can vary depending on the lender and the loan program.
So it's always a good idea to shop around and compare offers from different lenders.
Absolutely. You want to make sure you're getting the best deal.
For sure. Now, while there's no magic number for DTI, Cho recommends aiming for a housing ratio that's the front-end DTI between 25% and 28%.
Yeah, he says that range usually means a back-end DTI of around 35%, which is a pretty comfortable level for most borrowers.
It gives you breathing room to manage your housing costs and still pursue other financial goals.
Exactly. It's all about finding that balance. And the key takeaway here is that understanding these formulas gives you the power to approach your mortgage with confidence.
It's about taking control and making informed decisions that align with your financial goals.
Instead of feeling lost and overwhelmed.
Right. But even with all these numbers and calculations, there is another crucial factor we need to consider when deciding whether to pay off the mortgage or invest that money: risk tolerance.
Ah, yes, risk tolerance. That's a big one. And it's different for everyone. Some people are totally cool with like a roller coaster ride when it comes to their money.
Oh, yeah. Some people love that adrenaline rush.
Right. But others, they just want stability and predictability above all else.
It's true. I know people who freak out over like a tiny dip in the market.
And then others are just buying the dip every time.
Exactly. And both approaches are totally valid. It's about what works for you.
It all comes down to your own comfort level and your financial goals.
Like someone with a higher risk tolerance might be more inclined to invest that extra cash in the stock market where they could potentially see bigger gains, but also bigger losses.
Exactly. They're willing to ride those waves.
Whereas someone with a lower risk tolerance might sleep better at night knowing their home is paid off, even if that means slower growth overall.
It's all about peace of mind, right?
Mm,
There's no right or wrong answer here. It's about understanding your own financial personality and making decisions that feel good to you.
I love that. So we've got Johnson challenging us to think strategically about our mortgage and maybe using that money to invest. And then we've got Cho laying out the nuts and bolts of mortgage math, showing us how lenders evaluate our financial picture.
It's like having two different lenses to look through.
Totally. And ultimately, you're the one who gets to decide which path to take.
You get to choose your own adventure.
Exactly. It's about taking all this information, weighing the pros and cons, and figuring out what makes the most sense for your life.
And that's what makes this whole conversation so interesting, because we're not just talking about numbers. We're talking about your life, your dreams, your aspirations.
It's about the big picture.
Exactly. How does owning a home fit into that? What are your priorities? Are you saving for retirement? Kids' college funds? It all comes into play.
I think sometimes we get so caught up in the shoulds of personal finance, like what we're supposed to be doing, that we forget to ask ourselves, what do I actually want?
That's such a good point. It's about taking control and making choices that feel right for you,
Right.
not just blindly following someone else's rules.
Right. It's about having the information, the knowledge, and the confidence to say, this is what works for me and my situation.
Now, remember that scenario Johnson talked about, the earthquake scenario?
Oh, yeah.
That really got me thinking about home ownership and that whole idea of security.
It made me question some things for sure.
Right. Because what if your top priority, feeling secure? Is there a point where that peace of mind of owning your home outright outweighs the potential gains from investing?
That's the million-dollar question, right? How do you balance those competing desires?
Well, I think it goes back to risk tolerance. For some
Yeah.
people, that psychological benefit of having a paid-off mortgage, that feeling of freedom and stability might be more valuable than any potential financial gains.
It's like an emotional return on investment.
Right. It might not show up on a spreadsheet, but it's still real and valid.
I like that. So it's not just about the numbers. It's about understanding what truly matters to you and making decisions that align with your values.
Exactly. And there's no judgment here. It's about finding that sweet spot where your financial strategy and your personal priorities meet.
It makes the whole financial planning process feel less intimidating and more personal.
It is personal. It's about your life, your goals, your dreams. It's about making choices that empower you to live the life you want.
Okay, so we've got Johnson's big picture strategic view, challenging the conventional wisdom about mortgages and urging us to consider the opportunity cost of paying off our homes versus investing.
And then we've got Cho's deep dive into the math behind mortgages, breaking down those key formulas. LTV gross monthly income DTI, and how understanding those can really put you in the driver's seat.
It's been a wild ride. We've gone from big concepts to nitty-gritty calculations, but it all boils down to this. What do you want to achieve with your money?
What are your goals? Your dreams? How does owning a home, whether it's paid off or not, fit into that vision for your future?
These are the questions we should all be asking ourselves. And remember, there's no one-size-fits-all answer. It's about making choices that align with your unique circumstances and your personal definition of financial success.
Wow, this whole deep dive has really been eye-opening. I'm looking at my own mortgage in a whole new light now.
And that's awesome to hear. It's
Yeah.
all about feeling empowered to make those decisions, right?
For sure. And one thing that stuck with me is Johnson's point about opportunity cost. Like, yeah, paying off your mortgage early gives you peace of mind and that feeling of security. But what if that same money invested wisely could actually give you even more security down the line? Right. It's about thinking long term and considering that potential growth you might miss out on.
It's like shifting your mindset from just getting rid of debt to actually building wealth.
Exactly. And that's where understanding those mortgage formulas Joe explained comes in. Like knowing your LTV, your DTI, how those impact your loan terms. It can really give you an edge.
Yeah, it's like you're speaking the lender's language.
Exactly. You can negotiate from a place of knowledge.
Okay, so let's wrap this up for our listeners. We've explored these two contrasting perspectives. Pay it off or invest. What are the key takeaways here?
Well, I think the biggest one is that there's no right or wrong answer. It all comes down to your individual circumstances, your goals, your risk tolerance. You got to figure out what's right for you.
I love that it takes the pressure off. It's about making informed choices that fit your unique situation.
Right. But to break it down a bit more, if security and peace of mind are your top priorities, and having a paid-off mortgage will give you that feeling of freedom, then maybe that's the way to go.
Hmm.
You can always explore other investment options once the mortgage is gone.
And if you're okay with a little more risk and see that potential for big gains through investing, then maybe that's the strategy you focus on. The key is to be intentional and make choices that match your long-term vision.
And don't forget about the power of knowledge. Arm yourself with information. Understand the terms of your mortgage. Explore different investment options. Maybe even talk to a financial advisor if you need help. The more you know, the more confident you'll feel making those big decisions.
So listener name there, you have it. Two different viewpoints on this age-old mortgage question. We've looked at the big picture, the details, and everything in between. Now it's up to you to take all this info, reflect on your own goals, your risk tolerance, and make the choice that feels right for you.
And remember, this is a journey, not a sprint. Your financial situation is going to change over time. Your priorities might shift. Stay curious, keep learning, and don't be afraid to adjust your course along the way.
That's some great advice. Thanks for joining us on this deep dive. We hope you found it helpful and empowering. Until next time, happy investing.